I talked about the fact that there was this social media concept called velocity banking that proclaims that if you do this according to its instructions, you can pay off a 30-year home loan in 12 years, 10 years. Some people say 7 to 10 years. And it's something that's been taking off over recent years when it comes to something that you might see on TikTok or something that you see on YouTube. There are people who devote their entire careers to building a profile off of teaching the velocity banking concept. And it's something that when you see it, it kind of sounds too good to be true. So in this episode, I want to talk about the concept in the first half of the episode, show you how it can work when done properly and when certain circumstances align in your favor. But in the second half of this episode, we'll tell you how likely it may be and also some of the cons that you need to be aware of. Because I would tell you that this is never something that I would recommend without you working with a licensed professional, and probably more than just one. In addition to a financial advisor, I'd recommend you having a CPA, you being in communication with your lenders to have an idea of things like your tax impact, the interest rates, all types of things that you need to be aware of when it comes to a complicated concept like velocity banking. So let's jump into how it works. And then as I shared in the second half, we'll talk about whether or not it's something you should pursue. The first step in velocity banking has to do with something that we also did an entire episode on, and that is securing a home equity line of credit. And you'll recall that in that episode, you can't secure a home equity line of credit unless you have a property that has equity in it in the first place. So if you're looking on screen, you're seeing an example of a home that's worth $500,000, and we're currently assuming that the mortgage payment on that mortgage as is about $2,400 a month. Now, the mortgage on that property is $300,000 at 6% interest. So you're looking at about $200,000 worth of equity that they've established in this property. And if you go back to that episode, you'll know that most lenders will take 80% of your home's value, in this case, $400,000. They'll subtract the balance of the mortgage, in this case, $300,000. And what you have left is what's accessible to you in a home equity line of credit. So on this $500,000 home and $300,000 mortgage, we have a home equity line of credit where we have access to up to $100,000. If you don't borrow any money, you don't owe anything on the line of credit, but you have access to up to that amount. So once we've established this home equity line of credit, the next step in velocity banking is to determine an amount from that home equity line of credit that you're going to use to pay down that mortgage. So you're not necessarily taking extra money from your own pocket and paying it down. You are borrowing from another source of debt to pay down the original source of debt, which already carries its own risks and complications. But in this step, in our example, we're going to assume that our homeowner taps that $100,000 line of credit for $50,000, and they use that $50,000 to pay down the mortgage balance from $300,000 to $250,000. Now, if you're looking at this, you're probably saying, why would a person do this? Because they still owe $300,000 in total. They have just shifted how they owe it from $300,000 on the mortgage to $250,000 on the mortgage and $50,000 on the line of credit. What's worse, the mortgage is likely a fixed interest rate mortgage where that 6% is never going to change, whereas the home equity line of credit is a variable interest rate debt. So they might have it at 8% interest now, but if interest rates increase, maybe it rises to 9%, 10%, 11%. There's no limit in most cases as to how high the interest rate on a home equity line of credit can go. So why would they do this?